this is Jenny Kassan here to lay down the law for you about all of the creative tools and strategies you need to know about and legal rules to be able to raise money for your business on your own terms. And I like to share different topics all about fundraising, sometimes more from a legal perspective, sometimes more from a strategy perspective. And one thing that I thought I could share about, because I get a lot of questions about this from my clients, is valuation. How to value your company if you're raising money. So, if you decide to raise money using equity, so you're selling stock in your corporation or you're selling a membership in your limited liability company or even equity in your co op, you have to put a price on that equity. And whatever the price is on the equity basically sets a valuation for your company. And a lot of people just go through a lot of, stress over trying to figure out what value should I put on the company. And the thing is, there really is no science to setting a valuation. And in a lot of cases, the valuation really doesn't matter that much. So with my clients, the people I work with, they're not in a huge rush to sell their company. So when they offer equity to investors, investors get paid through lots of different strategies. Generally, they get to share in profits from the business. They may be able to redeem their stock at a certain pre-agreed price. So, because of that, really the valuation of the company doesn't matter. When the valuation really matters is when the only way your investors get paid is through them. It's through basically you selling the company at a higher value than the value at which the investors invested. And so that's why in the venture capital world, valuation's really, really important because the investors want a relatively low valuation so that they can have the biggest jump in the price of their investment when you sell your company. But if that's not really your plan to do things that way, the valuation doesn't matter that much. And I would say it's funny, like even in the world of the more venture capital style investing, it's not so important because valuations for early stage companies are, I'd say, in the range of about 4 to 5 million, and no one cares that much about the details, I think. And again, I'm not part of that world, so I don't quote me on this, but I get the impression that if a venture capital style investor is investing in your business, they're expecting you to grow so much that the difference between like a 4 or 6 million valuation in the beginning isn't a huge deal. So, and I've had clients set valuations anywhere from like 2 million to 10 million, probably even more. And it's really just something you need to decide and be able to justify. And if the way you're raising money involves sharing profits or, share buybacks with your investors, then really the valuation doesn't matter that much anyway. So I'm going to give you a tool you can use to try to figure out a valuation. So first of all, you need to know the difference between pre-money valuation and post-money valuation. So pre-money valuation is basically the valuation that you're going to set when you're raising money from investors. Post-money valuation is the value of the company once you've raised money. So for example, if I set the value of my company at $2 million, and then I raise $500,000 from investors, I add that 500,000 to the value. So the post-money valuation is 2.5 million. So I would say that the best way to set a valuation is to just think about what percentage of the company, the ownership of the company, you are comfortable giving up for a certain investment amount, that whatever the investment amount is that you're raising. And this could be a little bit different if you're going to raise multiple times or if you're only going to raise once. If you're only going to raise once, it's easier to figure out because you know that once you raise your target amount of money, things are pretty much set and you don't have to worry too much about being diluted in the future. So if you're going to raise more, then you might want to create a little bit more cushion in case you need to raise a larger amount in the future. And probably if you do raise a larger amount in the future, it'll be at a higher price, a higher valuation, but still you want to, not get too diluted early on. um, so like in that example I gave you, if I value my company at 2 million and then I sell and then I raise 500,000, so I'll own 80% of the company in that case. And that may be a little too low if I'm going to be raising more money. So, here's an example. Let's say I would like to raise $500,000. And I'm pretty sure that once I raise 500,000, I may not need to raise again. And if I do, it'll be kind of a ways off. So I don't have to worry too much about the future, but I don't want to get too diluted. So I say to myself, you know what? For $500,000, I'm willing to give up 10% of the ownership of my company. So who can tell me if you can put this in the comments? I want to give you a chance to do the math in your head before I tell you the answer. So you say to yourself, I'm going to raise 500,000, and for that amount, I want to give up 10% of the company. In that case, what is your pre-money valuation? The answer is 4.5 million, because once you raise 500,000, your company will be worth 5 million, and 500,000 is 10% of 5 million. Does that make sense? So that's basically how it works. And who knows, you may not end up raising 500,000. Maybe you'll realize, gosh, I really don't need to raise that much, and you only raise 100,000. In that case, you would end up owning, if you raised 100,000, you would end up owning 98% of your company, and your investors would own 2%. Or what if you realize, gosh, I actually needed to raise more, I'm going to raise 1 million. In that case, you would end up owning 82% of the company. So the pre-money valuation is 4.5 million. That's what you own. You raise another million, so you own 4.5 divided by 5.5, which is 82% when all is said and done. Another thing to keep in mind is that pre-money valuation might not be 100% owned by you. You might have some co-founders. So that could also dilute you to some extent. So that the pre-money valuation is the ownership of the founders before, whether it's just you or you and some co-founders, before you raise any equity investment. So I hope that made sense. Please go ahead and put in the comments. So I look forward to hearing any questions you have about valuation. And if you have any requests for things that you want to learn more about, just let me know. I'm happy to talk about any topic that you're interested in. All right, bye.